Let's talk about whether you think now is a time to dip cautiously into the market or a time to play more defense.
Yes, absolutely. And I'm 100% unanimous on that, Tyler. Look, there's always something out there that you can buy. This market has pulled back maybe 4% off of the highs from April 23rd. Overall, we're still up over 20% since the lows that we made on the big pullback in December. This isn't awful. We made new highs in April. We've pulled back 4%. The world isn't coming to an end. We have a lot of issues, but in general, the economy's okay. Interest rates are low. The Fed's accommodative. So you try to hit them where they ain't, and you can try and find some opportunities and I think some stocks that perhaps have not done as well or perhaps have pulled back a little bit. There's opportunity there. I think there's some buying there, but I think you do have to be. I think you do have to be cautious.
I'll come back to you and ask you for some names of stocks, and I'm warning you: you cannot mention Johnson & Johnson. You cannot. You are enjoined.
I will not mention Johnson & Johnson. I will not.
You cannot. All right. So, Oliver, let's turn to you. Yeah. Should investors just sit back and get ready for a prolonged trade battle with China that may not be limited to trade, by the way, but into other areas of conflict?
Well, the short answer is yes, but I don't think that necessarily means that you have a horrible market scenario, right? I mean, so the world is slowing. The trade war with China is starting to see its impact across various channels in the economy. But corporate earnings are still pretty strong. Consumer confidence, as we saw this morning, continues to be strong. So I think stocks are probably priced where they ought to be right now. They're not expensive, but they're not cheap. And there's a lot of question marks about what happens over the next 6 months. I think, to Michael's point, you want to be opportunistic in this market. You want to look at areas that are growing, because there are areas that are growing, and you want to invest in category killers, as we like to call them.
Would you apply that to the parent company, the New York Stock Exchange, ICE?
Yes, absolutely. I mean, they're growing across multiple channels. They're doing a wonderful job. They're just one of the many portfolio names that we like in this environment. I mean, basically, from our perspective, is when the world is slowing down, you want to look at companies that are outperforming, that are growing, that are gaining market share, and are improving margins. If on top of that, you can have a company like ICE, Intercontinental Exchange, that's returning free cash flow in terms of additional dividends or share buybacks, those tend to outperform in a slowing environment and give you some insulation.
And Microsoft is another category.
Yeah, Nadella has done a great job. Yeah, I mean, he's done a great job turning around the culture within Microsoft, but also in turning around the business lines and enterprise software, and they continue to grow like they're dominant.
So, Michael, it's your turn to not mention Johnson & Johnson. As you put on your stock-picking hat, where would you look?
Okay, I'd still look at some things that I think hold some pretty good potential. I will shock you this time. I like Facebook. I've liked Facebook for a long time. I think if you ever want to figure out how not to deal with the media and public relations, take a good close look at Facebook and do the absolute opposite of everything these people have done when faced with any type of crisis. It is growing still in the mid-teens. They have a huge user base. I know some of it's fake. But when you listen to Mr. Wonderful earlier today on the halftime report, saying, look, I've got to advertise there. I get returns there. I make money there. I'm still going to be there because that's paying me to do it. Yeah, I like that stock a lot.
Michael,
I also like Accenture. Yeah, go ahead.
Sure.
Sorry.
Just before you get into that one, how long have you owned Facebook?
Long time. I've owned it a long time, and I've bought it. Let me see. I added to the position. I've added to the position in the past 6 months. When it really gets weak, I like to buy stuff when it's weak, when people start hating it. When they start loving it, I'll take some profits and take some off the table. But I'm very patient. 10 years is my time horizon.
Sure. And Accenture fits that, too?
I think Accenture, yes. I think Accenture's gotten beaten up. They've got a great services group in the tech area. And I think the valuation is reasonable. The growth rate's not going to be as high, but the price that you're paying right now isn't as high either. So that's another one where I think you can find some opportunity on a bad news story. I like to find these bad news stories where the fundamentals remain strong. And it's great to see Oliver here today. This is fun being on with you, Oliver.
Yeah, I agree with Michael. Just on a last note, we like companies that are dinged, not broken. So when you can get a discount because fundamentally it's strong, but there's just a piece of bad news out there.
Would you put Boeing in that category?
To be determined, but probably, yes.